also going to see a lot of companies go belly up. The Feds are now in a position, guys, where I think they have to pivot. So let's get into why that is. Man, it is a crazy day today. Nothing new, as we all know. Ray Dalio steps down from Bridewater Associates. This fund was dominating the beginning of this year, up 32% in the first half of the year, and had an annualized rate of return of 11.4% since inception of 1991. Pretty impressive. Ray Dalio's history is pretty phenomenal. He's definitely one of the guys we talk about when we talk about investing. It'll be interesting to see if he's more active verbally on what's going on economically, as I find this step down to be pretty interesting time for him to be walking away. And as we can see, it has been a rip your face off rally the last couple days, with one of the worst months in a long time coming in September, basically one of the worst months since the pandemic, and 98% of stocks are currently up. It is an everything rally, risk on. When people say risk on, that means pretty much everything you could pick is going up, and that is what's happening today. We are starting to see a cool off as job openings plunge by more than 1.1 million. Now, this is exactly what the Feds want. We all know this. The market is digesting this as good news, but guys, not so fast. There's a lot of things I want to talk about here. Yes, short term, this is absolutely going to be good news for the market as the Feds are doing their job. The problem becomes this is definitely recessionary type behavior. And while we're getting some sort of rally, I just don't think it's going to last. Guys, if you've been following my channel, I told you to get the hell out of the way around 4,800 on the S&P. I'm starting to slowly dollar cost average back in this market as I think we are at a halfway point. Let me repeat that. We are at a halfway point, which means I will not be shocked if the market breaks below 3,000, right around 2,800 in a worst case scenario. And I also think we're going to see some more blood in the streets when it comes to the job market and layoffs. Now, I think we will see one more rate hike, and I think this will be the last rate hike. By the end of this year, I think all rate hikes will be out of the way, and 2023 will be more about unwinding a balance sheet. But guys, I also think they might have to pivot at some point in 2023, as higher interest rates are going to cause the national debt to be more expensive. Why would they want the national debt to be more expensive? Guys, they don't want the national debt to be more expensive. We are starting to see a global slowdown. Inflation is impacting the globe right now, and we're starting to see monetary policy tighten, which is going to cause global debt to get more expensive, and it could cause some imploding. Now, this is stuff we've been talking about, guys. We've been saying it since the get-go. We have to keep our eye on interest rates. While the stock market is a very emotionally driven market, the interest rate market is telling us there is more pain ahead, and I tend to believe the interest rate market over the stock market, as there's no such thing as meme stocks in the interest rate market. There's no such thing as SPACs, and is not as easily manipulated as the stock market. But in the stock market, you can. So therefore, I tend to lean more towards the thing that is less manipulated, and that is going to be bonds. $1 trillion over the next 30 years, and that would make up nearly 40% of all federal revenue by 2052. Guys, let me repeat that. Interest would make up 40% of all federal revenues by 2052. Interest costs would also become the largest program, guys, the largest program over the next few decades, surpassing defense spending. Now, I don't want interest payments to surpass defense spending with political tension as high as it is. We all obviously know the importance of defense spending, and there's no way that interest is going to surpass defense spending. This is one of the reasons why I think we're going to see a very strong pivot in the very near future. Not only would it surpass defense spending, it would surpass Medicare and Social Security by 2049. Social Security could absolutely vanish if interest rates don't get under control. So as every second goes by, we can see that the national debt is expanding, and interest is going to be a huge burden in the near future. We're basically bankrupt as a country, as the debt is absolutely surpassing what we can probably produce over the next few years. So in a 2013 study, a healthy debt to GDP ratio should not exceed 77%. We are going into a period of slow economic growth and slow GDP. Now, I know we all know, I know we can fight on the word recession, but we've had negative GDP growth, which is not good when we compare it to our debt. This is a very unhealthy model, and that would be equivalent to us investing in a company that is unprofitable and burning capital to grow top line. And that is what's happening right now in the United States. We are getting negative real growth and even projected very low growth in the fourth quarter. And going into next year, it's projected 2 quarters once again of negative GDP. This is not good when we topple this with the national debt growing and high interest rates. So essentially, we are digging ourselves in a massive hole here, but it becomes, what is the better of the two evils? Do we deal with people dying because they can't keep up with inflation and can't put food on the table? Or do we deal with a horrible balance sheet on the United States economy? So when we count down how many negative quarters of GDP we're going to have, it is going to be 1, 2, 3, 4. 4 out of the next 5 quarters of GDP is going to be negative, on top of a debt that is consistently growing with higher interest rates, which means the cost of that debt is absolutely skyrocketing and is going to cause the debt to GDP ratio to really become out of whack. So as we can see here, the debt to GDP has done nothing but skyrocket since 2020, which we understand why that is, but now it is time to get it under control as we're pushing 137% debt to GDP. Come into 2021 where it absolutely skyrockets to 137% of GDP. This is not good, and it's only going to get worse in my opinion, especially when we topple in more negative quarters of GDP and interest rates on the rise. So at some point in time, this is absolutely going to come to roost. Not sure when that will be, but it will come to roost. So while we are getting a really nice rally, and I think that there are some tremendous opportunities in the market, especially when we get to that 35 to 3,600 mark on the S&P 500. The more I look long term here, there are still some concerns on the table that I think we need to really pay attention to as long-term investors. As I stated before, guys, I just don't think this is going to be a V-shaped recovery. And the more I'm looking at the debt and the more I'm looking at the global recession signals here, I tend to think that we are just really starting this downward process, and we probably have a little bit longer than I originally thought. Now, with that being said, if you are a long-term investor, it is a great opportunity at these prices to start dollar cost averaging in. The more I look at this long term, in order to get everything under control, the first thing that needs to take place is we obviously have to get inflation under control within the next probably 18 months, in my opinion. I'm not saying we need to get it to 2%, but we probably need to get it close to that 3.5%, get it at least as close to 2% as we possibly can. After that, I really think the Feds are going to have to pivot here, guys, for many reasons. If they don't pivot, I think they will push us into a depression. And on top of that, we have to worry about negative GDP on top of the United States debt service. So we have negative GDP, debt service skyrocketing, and we could possibly head into a depression if this is not done right. So the more I look at this, the more concerned I'm actually am longer term than I originally thought. Maybe this is the start of a secular bear market. Now, this is just my opinion, guys, but I'm starting to look at some signals here that I'm wondering, how are they really going to land us? How are they going to land us in the next 18 months? To a soft landing? And if interest rates keep rising here and it becomes a huge part of Federal Reserve's revenue, we have some massive issues with defense spending and Social Security. So just wanted to touch base. Hopefully you all enjoyed that. As always, guys, I shoot it straight. Appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.